This, all right, told me recording's in progress. So this is a meeting of Exemplar Capital's weekly capital call. We decided to make this a public recording because I'm going to give a little background on an investment newsletter I've been writing for about 10 years. But more specifically, we're going to be talking about a fairly extensive economic analysis I've done recently in terms of where we are right now in the economic environment and where we're most likely going in 2023. So for the investment banking folks on this call, it's going to be very, very helpful, I think, to have kind of an idea of what the current environment that we're in is, kind of just look at all the components of that, and kind of what to expect going into the new year. And for anyone else that's joining this call, that watches this video, again, it might be helpful for investors and anybody else to understand where we are. So let me get started on that. I'm sharing my screen right now. And let me see here. Oops. Okay. What I'm going to be showing here is an investment newsletter I've written for this one and a predecessor. This is the Intrinsic Value Wealth Report newsletter. The predecessor to this newsletter was just called the Intrinsic Value Wealth Report. I actually started that, about 10 or 12 years ago, I guess. The predecessor to this, I really started. It was kind of the website. It started out as an investment newsletter, but it also became really just a repository for information, material stuff, academic stuff that I used in classes I was teaching. So it's become quite an extensive database. Actually, I'll just give you a quick peek at that. And that's all I use this one for right now. This one, the Intrinsic Value Wealth Report, it's now just for stuff I use when I teach classes and so forth. This one here, the Intrinsic Value Wealth Report newsletter, I try to keep more up to date, although the last issue before the one I just did earlier this week was in January of this year, just because it's been a busy year and I hadn't had time to keep it up. I'm hoping now to publish this on an every couple of weeks basis, and you'll kind of see what I try to accomplish with this. So, by the way, I will send everyone the login. This is actually a subscriber-based newsletter. So I'll send everyone a free login to get onto that. But I always start out with some sort of a little introductory section. This was a particularly long one because, again, it had been since January since the last time I published this. And I'm just going to hit some of the highlights. I don't want to take a lot of time going through the whole newsletter. You can do that on your own if you're interested. So let me come down to one of the things that I've decided to do going forward with the newsletter. Many of you know that I created a theory in economics called the value creation theory of the economy. Started working on that several years ago, have presented it to to many groups actually, but in particular to the International Leadership Association. Started back, I think in 2019, presenting it to that group. I think that year was actually up in Toronto. And so I presented this paper as it was being developed, went from Toronto to Geneva to, we were in Washington, D.C. last year, and Ottawa, I think, at one point in time. Anyway, I presented the final, so I worked on it for several years, this theory. And the basic idea of the theory, let me just see if I can, the purpose here. The purpose of this economic study using the grounded theory research design and an extensive review of an incorporation of other economic and financial models and theories is to explore how free market-based capitalistic economies operate through business enterprises to create economic prosperity. And so again, that will be kind of a theme as we go forward. Basically, at least in this part where we're using the theory as a basis for some discussions, it's the whole premise of this study of this economic theory is that it's businesses that create the value in the economy. And again, we'll kind of explore that as we go forward from time to time over the coming year. While that seems obvious probably to everyone on this call because we're all of a similar mindset, we're business people, we're investment bankers were into the capitalist economies. It's actually not obvious to an awful lot of people in the world. And I've discovered this more and more the more talks I give and the more classes I teach. And as I think we all know and have an appreciation for, there's a real divide, not only in this country, but I think on a global basis in terms of those that believe in really the capitalistic way of doing things and those that don't. Actually, it was John Mackey, the co-founder of Whole Foods Markets, that observed in one of the talks he gave at Freedom Fest a few years back. He was shocked to learn that more than 50%, this was, I think, in 2016, he observed that more than 50% of millennials believe that socialism is actually a better way to organize economic activity than capitalism is. And that was shocking to me as well. But, I say, having talked with so many students over the years, literally thousands of students and other groups I've talked to, that really is a very prevailing attitude, probably about half and half. So that was actually kind of also what prompted me to really kind of think about this economic theory, and write a paper on it and come up with some ideas about how it really is businesses that start the process and keep the economic process going. So again, well, I'll be kind of a subject as we go forward in the podcasts I do and some of the newsletters. Now, the newsletter really, though, is oriented toward looking at the current economic conditions and the current investment climate. That's been its objective in the last 10 years since I started it. Okay, so again, more on that as we go forward. A lot to cover there. So we do have a podcast as part of this whole intrinsic value wealth report scheme of things. There's a podcast, there's the YouTube channel, which this recording will go on. So again, we're kind of a whole series of things that we have to talk about all of our investment economic ideas and now the new theory. I kind of mentioned at the bottom of this, and for the bankers that are on the call, after the first of the year, I have two very small hedge funds, which have really just been primarily me investing in them, that I started and manage the Northwest Quadrant, and note these words, alternative investments. So Northwest Quadrant Alternative Investments Opportunity Fund and Northwest Quadrant Alternative Investments Venture Fund. Most of you on this call know that we have a real focus in the alternative investment side. As we've talked about many, many times, we have kind of the three silos, the three verticals, being the traditional investment banking that we do, the alternative investments, which is real estate and oil and gas and all those things we see when we go to the TNDDAs and the ADISAs and so forth, and then now the crowdfunding. So that fund really concentrates on, because we're well tied into those groups and we can see the opportunities, this fund was designed to invest in those, and we have due diligence reports that are done. So it's you kind of to be able to get an effective investment in this, you have to have access and knowledge and research being done, and those are all because of where we stand in the industry and so forth. Those are the opportunities that we have. So it just made sense to put together a fund. Like I said, we've been actually running this fund for about a year now. It's been mostly with my money in it. The other fund, just mentioned briefly, Northwest Quadrant Alternative Investments Venture Fund. That came about as an idea, I think, at the beginning of this year, back around January, maybe the last part of last year. And because we were getting into the crowdfunding space at the time, it made sense to look at all the different crowdfunding platforms and kind of cherry pick ideas. Artem, who's on the call with us, was helping me in that endeavor before we both joined Exemplar, and I expect we'll continue in that as well. But so we go out to the crowdfunding platforms and we kind of cherry pick ideas. We also, some of you may have read how bad the SPACs have been having it this year. In fact, the latest article I read is that many of the SPACs are having to liquidate because they just can't find companies now. But pretty much all the SPACs that were so successful, so popular in 2021 have now really, their prices have fallen tremendously, most of them in 2022. So, we're value investors, we're bargain hunters. So, that's a great thing for us. We actually did already pick up some good deals previously this year, but there's more to be had. And by the way, one of the key characteristics of alternative investments is that alternative investments are inefficient markets. And again, we'll cover that more in future podcasts and the newsletter write-ups and so forth. But basically, if you have an Apple computer or Microsoft or any of these companies that you have thousands and thousands of analysts around the world that follow those are efficient markets. Any information that comes out, everyone has access to equally, and just all they have to do is make their own independent judgments. And that's what's meant by an efficient market. Doesn't mean that the markets are right, just means that everyone has equal access, and then the market kind of collectively decides what it's going to do with that information. In the inefficient markets, like the alternative investments are, there's very limited access. Again, you have to have knowledge, you have to have the contacts to get into those markets, and most people don't have that. So inefficient markets like alternative investments give investors really an advantage, an investment advantage, because of the inefficient nature of those. Again, more on that later. All right, so that was just kind of the introduction to that. Again, you can read this on your own if you're interested. In this newsletter, I always kind of give the previous week's highlights, and I started doing this a lot just because it was beneficial for me to kind of sit down, once a week and review everything that had been happening in the previous week. And in writing this one here at the beginning of the week, I was surprised at how many things, all the way from the FTX co-founder Sam, what is it, Banks-Friedman or something, I forget, to Elon Musk. I mean, it's been an exciting week. Actually, this was just 1 week's worth of data. So it's just a good little summary of some of the more important events that I've chosen as what I think are the most important events. And then I give a lot of resources here for people to be able to look at. So the Econo-Days economic calendar, most people won't really have an interest in diving into this at this much depth, but if you should be interested, Econo-Days is a pretty good service. You can get their free economic calendar anytime just by clicking the link and going there. I'm going to get down here in a minute to a couple of very important economic forecasts, and that's really kind of one of the points of this call. But some of the resources that are published by the various branches of the Federal Reserve, the regional Federal Reserve. So the Aruba Diebold Scotty Business Index. And these, by the way, are very short-term indicators, like the ADS, they call it, or I'm sorry, the ALS index. That's kind of, they update that on pretty much a weekly basis. And this is just very, very short-term things, looking at the economy and saying, what's going on at the moment. So both this and the GDP Now, which I think is published by the New York Fed. The Aruba Diebold, I think, is the Philadelphia Fed. They're both basically showing neutral right now. They had a big drop, during the pandemic declines in the economy, and big spikes in the 2021 recovery and so forth. So they actually do work pretty well. I mean, all of these indicators that we use, you have to use all of them really to kind of start getting a good sense of what's going on with the economy or investment forecasting. The more you use, the better. It's always a trick question I ask my students, because they figure it out pretty quickly. I say, well, which model are you going to use? And it doesn't take them long to figure out that they say, well, you use all of them, because that really is the point. So we like to look at a number of different indicators. Sometimes they're contradictory to each other. Sometimes they agree. So anyway, that's what we do in this little section here. One really good indicator of how investors are thinking about the market, because they're a pretty good cross section of all the investors, actually across the globe, is this AAII sentiment survey. And so it's American Association of Individual Investors, and they ask their subscribers. Actually, anyone can contribute to this. You don't have to be a subscriber. They ask them on pretty much a weekly basis, how do you feel about the markets? Do you think there's going to be a strong market, a neutral, or a bear market? The historical average is that about 38% of the people on average think that we're going to, over time, have thought that we would be in a strong market. The current reading, so their expectations of stock prices rising over the next 6 months, their current reading is only 20.3%, versus on average they think that the market's strong at a level of 38% of respondents. Okay, 27.4% think it's going to be neutral, and 52.3% are thinking there's going to be a downturn, in other words, a bear market. And that's pretty significant. If you're an investor and you got all the other people that you're investing with, now this is individuals, and there is a very definite difference between individuals and institutions right now. For the most part, individuals have been piling into the market, while at the same time, institutions have been piling out. So, this just reflects individual investors' attitudes. But again, individual investors are not too bullish right now. In fact, they're overall bearish. Some of you on this call know Dr. Mark Skousen, my friend Mark Skousen, who is the producer of Freedom Fest, and well-known economist, teaches at Chapman University, and other places as well. But he kind of championed this economic measure called gross output. I'll do a little section on gross output someday, but basically it goes further up the chain from just gross domestic product, which is what most people use when they're assessing the economy. And that's kind of a bottom line number, as Mark would call it. Gross domestic product is comprises consumer spending, investment spending, government spending, and net exports. But if you go a little bit further up the chain from gross domestic product, then you look at what businesses are doing and all the activity, all the stuff that goes into that final GDP number, which is a final production number. And so Mark likes to look at that, and he's usually been, as long as I can remember, he's been pretty bullish on the economy using the gross output number when GDP has been reflecting a more pessimistic view. This is the first time that I can remember where he's actually saying here. So he says, while the lower growth rate suggests, so the lower growth rate in both gross output and GDP, while the lower growth rate suggests a slumping economy, they're still in positive territory and do not indicate a full-on recession just yet. However, while the adjusted real gross output data shows no recession in 2022, it does suggest a pattern of an economy slowing down and headed perhaps into a recession in 2023. Depending on how long, and this really is the key, I think, for most of the stuff that I read and follow, depending on how long the Federal Reserve imposes tight monetary policy. And so you're going to see here in a moment, that's a recurring theme across, amongst many economists. I would even go as far as to say most economists really do expect not good times ahead for the economy. And this is kind of the first indication of that with Mark's gross output number. In fact, here, so this comes from the Survey of Professional Forecasters, which is the Federal Reserve of Philadelphia. Forecasters predict lower growth and higher unemployment rate. I won't read through this whole thing, but basically they're looking at here, I think these bottom line numbers may kind of tell the story. Forecasters expect real GDP to increase 0.7% in 2023. That's pretty low. Normal growth for the economy is in about the 2 to 3% range. So it's 0.7% in 2023, 1.8% in 2024. And it doesn't actually show the number here, but we're looking at it a little bit. Well, actually, I've got another place. I'll show it here in a moment for 2025. I think really significant thing, though, is what they said at the end of this survey of professional forecasters. The forecasters see the risk of a downturn this quarter. So in other words, Q4, which is almost done. We'll see the numbers in that, probably in 3 to 4 weeks, I would guess. The forecasters see the risk of a downturn this quarter at 36.3%, up marginally from the previous survey. However, they substantially raised their probability estimates of a negative quarter for the following 3 quarters, so Q1, Q2, and Q3 of 2023. They're looking at a near 50% chance of a contraction, in other words, a recession, in any of the 4 quarters in 2023. So again, Mark's kind of looking at his geo numbers and saying, yep, looks like we could have a recession. The Survey of Professional Forecasters, which is about, the forecasters change from time to time, but there's about 38 to 50 economists from banks and, government forecasters and economists, and, they're all invited to participate in these surveys. So they're pretty astute group of people. And again, this group's looking at a downturn, pretty likely. And then finally, the National Association of Business Economists, which again is most business economists and other economists, the chairmen of the chair people of the Federal Reserve are usually part of the National Association of Business Economists. And again, they're looking at a downturn as well. So what does that mean for us as investment bankers and investors? I think the message is pretty clear that we are in for more rough economic times ahead. But again, it seems to hinge heavily on what the Federal Reserve does. And Chair Powell has made it very, very clear that for him, the most important thing is to combat inflation. And so if you're going to combat inflation, really the main tool that the Fed has to do that is to slow the economy down. And, that's why you've seen these tremendous increases in interest rates they've done. They did pull back a little bit on the last rate increases from 3/4 down to 0.5%. But that's still pretty hefty, and especially given the number of raises, interest rate, increases they've had. Now, the Fed knows very clearly that if they raise interest rates, it's going to slow the economy and eventually create higher unemployment. But again, their main objective, and they've said it very clearly, is that their main objective is to fight inflation. To them, that's the bigger concern, is that you have inflation which gets built into the economy and you can't pull it back. That happened back in the 80s. Some of you might remember that inflation and interest rates were both very, very high back then under Paul Volcker, and it took a long time to tame that. Actually, Volcker was the one that was really undergoing the efforts to bring that inflation down. And he was successful, but it's very painful if it gets out of control. So they're trying to say now, we're going to try and control this inflation. It's going to hurt the economy. And then they keep saying, but we want a soft landing. Well, soft landings don't usually happen, and they're very hard to achieve. So the idea of a soft landing probably is not something that we should really expect. And so again, the point of all this discussion, the reason I wanted to bring it up on this Capital call is really just to say, here's the situation we're faced with, guys. We are likely looking at a slower economy, or even a possible recession in the coming year. Does that end our business? Not by any means. Okay. Does it make our business a little bit harder? Absolutely, yes. Okay. But again, it's important to understand where we are. Deals will still get done. We'll still be able to raise capital. Trust me when I tell you, everyone always needs money, and they especially need it now in this environment because there aren't that many capital providers. So we'll find plenty of deals. We're just going to have to work a little bit harder about getting the deals done, but it can be done. And I've been through a lot of these cycles over the years, and one of the things I mentioned here in the newsletter is the markets are bad right now, but they things will turn around, and they always do. And there's sound economic reasons why they do turn around. So don't lose faith. It will be a tougher year, but things can still get done. One of the things I put into the newsletter here, again, I'm going to try and kind of just get through this, some of the highlights here, but I do a evaluation on the markets. I've been doing this for quite a few years now, so I have quite a database of these valuations. Last year when the markets were really extremely overvalued. I think one of the better indicators I use is the price earnings ratio. There's many things you can use to value the markets, but this is one of the more standard and I think probably better ones. It's just simply the price earnings ratio of the market. And over time, the markets have fluctuated between 15 and a PD ratio of 15 to 18. So on the low side, 15, on the high side, 18. And right now you can see the numbers are kind of in the 17. They went up to the 21 area and so forth. This blue line kind of tracks where they are relative to the band of the low, the 15 to 18. That's on the Dow. On the S&P, again, similar thing. We're kind of just right above the band. Now, if you looked at this last year, the current PD ratio relative to the fair value range, this blue band or this blue line was like way above the other band. And when you see that, and I spent all last year telling students and groups I would talk to and so forth, the markets are very overvalued right now. One of the funnest things I would talk about was Tesla. When it was trading at a PD ratio of about 400. And again, we'll use other newsletters and podcasts and so forth to talk about that. But when you get a PD ratio that out of bounds, it's still a pretty high PD ratio, as I recall. I haven't looked at it in a while, but 400, that's just ridiculous. And I would try to tell students, particularly young folks, this stock has to come down. It just can't sustain this. And of course, no one believes you until it happens. Most really young people haven't seen. They saw the financial crisis and the decline in the economy and the markets, but that was their first experience with, and they were pretty young, most of them, when that happened. So most of what I've covered in this little summary here, I always put a summary of where I think the economy is and markets and so forth, and that's kind of what I've just been saying here in the last few minutes. I always try to put a chart up here which kind of reflects the current stuff. See, the Fed's actions have actually been working because from earlier this year, this looks like about June or so, we had a peak of about 9% in the CPI, Consumer Price Index, and now we've actually come down a little bit. And so what the Fed has been doing has been working, but we're starting to see the painful effects of that. By the way, people, one thing is like consumer spending has still been pretty high, and you have to ask yourself, well, why is that? And one of the big reasons is people have been dipping into savings, and so people's savings now are starting to run out. So that's a little concerning too. I put this little model together, developed this one I developed back in early 1990s, about 1993 or so, the simple and effective economic forecasting model. Again, we can talk about this more. I actually did write a little paper on that, which you can see in the newsletter here. Here's a reference to that. And then I wrote this paper, Simple and Effective Economic Forecasting Model. I did that in about 1993, I think. But it's just a real simple way to look at the economy. It's weighted average subjective probability of what's going to happen in the economy. This is so 50% is kind of a neutral level. If you're above 50%, you're looking at a pretty strong economy. Closer you get to 100%, of course, 100% being perfect. But we're down about, by my estimates, down about 35%. And this reflects the same thing we saw with the Survey of Professional Forecasters, the National Association of Business Economists, gross output. Everything's pointing to the same direction. There's likely to be rough times ahead. So expect it. It's going to happen. More likely than not. And then, here is this chart. I thought I put this together several years ago, but I thought it was kind of interesting to see. So the green line here up to this point is gross domestic product and what it's done since 2007. This dip here was 2009, right in the height of the financial crisis. Then things kind of recovered for a while. This drop here, 2020, was the pandemic crisis. Then things got better last year in the economy. Q1 of this year were a little bit negative. Q2 here a little bit better, but still negative. Q3 they're looking at actually 3.2%. Actually, those are actual numbers. So Q3 was actually pretty strong. But then going Q4 estimated is down to about, let's see, what is it? 1.9%. So actually, yeah, 1.9%, a drop actually from the 3.2% that we're seeing in the third quarter. So again, this prediction, this forecast that things are getting a little bit rougher, that's starting to play out in the forecasts. And you can kind of study this later if you're interested. I'm calling for, and this is probably a little bit of a hedge on my part, but I'm calling for a flat economy over the next few years. And so that's my forecast right here, this kind of purplish line, I guess. The survey of professional forecasters, that's this kind of gold line. They're kind of all over the place. Again, you can look at the numbers in the table. But here's what a recession looks like, of about a 2% decline. Here would be a really, really good economy of a 4% increase. That's not likely for a while. 3% would be, that's about a normal 2 to 3% normal growth in the economy. Again, I don't think we're going to see that on a sustained basis for a while. So again, you kind of look at that when you get a chance. Then I just always have some announcements, and I wanted to just, one thing that's kind of useful, I think, and again, I've covered this in some articles. Well, actually, I'll show you the article I have on this value creation pyramid. And I wrote about this in an article I did for my Forbes forecast, my Forbes column. Let's look quickly at that again, because we've spent quite a bit of time on this, and I want to get through this a little bit quicker here. So that's the commentary I do in the newsletter. Again, I'll send everyone the access to that. But let me jump over here here's our podcast, by the way, is on this website. And I do the podcast kind of whenever. I try to do one a week, or, again, as I'm kind of now getting back into the groove of this, I don't know what the frequency is going to be. By the way, the newsletter, I'm thinking the frequency will be, it used to be every week, but that's a lot to keep that up. I'm thinking every couple of weeks would be going forward, probably a pretty good accomplishment if I could get those done. Here's the podcast page. We call this Intrinsic Value Wealth Report Radio. The Intrinsic Value Wealth Report TV is down here. That's where this recording will go. But what I wanted to show you is under the resources section. I write a little column for Forbes. I can write as often as I want, but by the time you really research articles and spend some time thinking about it, and then writing something that you really want to have posted in a public format like this, it takes a long time to get these done. So I've managed to get out about one a year. I guess I'm going to miss this year, but if I do it in January, February, I'll be more or less on track. So these are some articles I've written. But actually the first article I wrote back in 2018 was 9 of the best ways to build wealth. And that's where I talk about this intrinsic value wealth creation pyramid. And that's what the pyramid looks like. There's other places on the website, if you're interested, I can direct you to, well, actually, that's a pretty good rendition of it. So again, you can read about it here in the Forbes article, and we can talk about this in future podcasts and so forth too. Let me look at my notes real quick, and I think that was the main things I wanted to go through, and I wanted to leave a couple of minutes if anyone has any questions. One thing that I think would be helpful to share with you guys is, so this website here, just the plain intrinsic value wealth report, first one I started doing in 2012. Again, that grew over time to where I put a lot of stuff that I would use to teach classes. As most of you know, I teach classes in economics and finance and strategy and many, many other business and economics and finance subjects. And so as I started getting more and more material up here, I started organizing in books. So if you're interested in following the economy, you can just look at the commentary I do here. but if you really want to kind of dig into the weeds, into the numbers yourself, book number 6 here of the Intrinsic Value Wealth Report has a lot of links to, where is it here? Book number 6 has links to a lot of different resources. One of the better ones, I think it took me a long time to compile this list, and I think it's still fairly current. I did this a number of years ago. But these links, and some of the links I will tell you might be out of date, but you can just do a Google search if they are to find the information. But I organized this in terms of, again, the major components. If you're trying to forecast what the economy is going to do, you want to be looking at certain things. So the components of gross domestic product, GDP, are consumption, investment, which is mostly in business investment, but also includes household investment in their homes primarily. So there's consumption investment, government spending, and net exports. And then some of the other things that you want to look at, is we've all seen, in the headlines last year or so, are things like the employment or unemployment, however you want to look at it, interest rates, and inflation. And so I've organized these links by those major categories. And again, I've learned over time that the links change as people move their stuff to other websites and whatnot. But again, at least you can kind of see what the major categories are. So again, if you really want to dig into the weeds yourself, you can look at this. One other thing I wanted to show you real briefly, by the way, is a spreadsheet that I use to try and keep track of where the economy is going and where the world's going, frankly. So again, this spreadsheet is organized by those major components of real GDP, the numbers that come out on that, and the commentary that surrounds that, consumption, investment, government expenditures, net exports, but then a whole lot of other things. We'll give you just a little flavor for that. Because the more you can understand about what's affecting the world, what's making the world go around, and affecting the outcomes, the better chance you're going to have of really understanding what's going on with the economy. So back when COVID was more of a factor, I was looking at COVID numbers and what was happening there. Now, except in China, it's less of an impact on the world. Debt numbers are very, very important, and probably doesn't surprise anyone to know that debt is high for everybody. It's high for individuals, it's high for the government, and it's higher for businesses. And high debt numbers are never good, even though the government doesn't think it has to be paid back. There is a day of reckoning for everybody. Supply chain, again, that was something that was really important. Not so important now. In fact, actually, much of the supply chain is getting better. I even saw the other day that China, that there's an actual excess of chips because, well, the bad news is people are buying less stuff, so they're using less chips to make stuff. And then, productivity is really an important thing, because at the end of the day, what creates economic prosperity is productivity and production. And so, so it's really important to kind of keep track of how productivity is going. Let me see, leading indicators. That used to be a really important measure. It's something to look at again, but it's not the most driving thing in the economy today. Let's see. One of the ideas for putting together the value creation theory of the economy paper I talked about, I coined the term intrinsonomics for that. And as one of the major themes I'll be talking about in future podcasts, in particular with that, is that as the government in particular puts less emphasis on the real drivers of economic prosperity and creation is businesses. And again, I give a whole lecture on that, and we'll talk about that a lot in the podcast. But as the government, particularly the current administration, they want to tax businesses and tax wealthy people too. I always say, by the way, and I love to ask this question with audiences and in classes. I ask people, I said, what's another definition for wealthy people? I've got a picture here of AOC wearing a dress that said tax the rich or tax the wealthy. So what's another term for the wealthy? And all of us on this call will get get the other definition for wealthy. The other term for wealthy is investors, okay? Because the wealthy people are investors, and things like our conservation easements, for example, those tax benefits were put in place to get people to invest and and help create that economic prosperity. And so these politicians that just so flippantly like to say tax the rich, tax corporations, it's really, they're really hurting the long-term direction in terms of increasing the economic pie for everybody. So I put that in there as kind of a trend to watch. Unfortunately, the trend of recent has been not good. There's, the current administration is not anxious to do things that really help that long-term growth in the economy. So you get kind of a sense for this. The wealth effect is, by the way, that's something that a lot of people don't focus on a lot. The wealth effect is when the stock market's up and people have a lot of jobs and they're getting pay raises that aren't being reduced by the effect of that being reduced by inflation. They feel wealthier and they're more likely to spend and invest and save and so forth. Now we're in an environment where just the opposite is happening. So the wealth effect is really kicking in now, where people aren't feeling as wealthy and they're a little bit more worried, and that affects economic activity. Labor, the last one here is labor market participation. So that's when I was I was giving a talk down in Dana Point a few weeks ago at one of the conferences, and it was interesting. Someone in the audience asked this, because most people don't really realize what the labor market participation is, and I thought it was great that this gentleman had picked up on that. So labor market participation is basically the number of people that can be employed that are actually are employed. In other words, they're part of, they're working. Turns out right now, and on a long-term trend, that's been dropping, quite a bit over the last, several decades. Turns out that right now there are a little bit more people that are not working. So in other words, something less than something like greater than 60% of the people that are working are supporting, around 50% or just under of those who aren't working. So in other words, those that are working are supporting those that aren't working, and that's that can't go on for very, very long. The real simple economic principle is that if you want to increase productivity, which increases the economic prosperity and the standard of living that we all have, one of the main ways you do that is really the only way you do that is you increase the utilization of all the factors of production, so land, labor, and capital. And so if you got more people working and producing stuff, both goods and services, that leads to economic prosperity. At the end of the day, that's what needs to happen. Well, again, we're going the wrong direction. A lot of people are, especially through the pandemic, people have found other ways to get by without having to work. Families are living together. People have been using their savings. All these things aren't sustainable. So anyway, I think that was the main things I wanted to cover. Do you guys have any questions at all? Are you all still with me? Okay. Jessica, I guess you can stop the recording now. And then we'll just see if there's anything else from anybody offline. Jessica, let me know when you've got the recording.